Good afternoon. Welcome and thank you for joining us for the second installment of our webinar series on planning. First, some quick intros. My name is Michael Vidal and I'm a tax partner in Cherry Beckert's private client service group based out of the Coral Gables office. I'll let my partner in crime introduce himself.
Hi, everyone. My name is Gregory Marks. I'm a senior tax manager in the Coral Gables office as well, also in the private client services group.
Great. So during the first web, Mike Kirkman and John Orr kicked off the series and introduced a variety of topics related to succession planning. For family businesses, an exit strategy typically involves either a transfer or sale to either insiders, which could be family members, key employees of the business, or a transfer or sale to outsiders or third parties. In today's session, we're going to be basically taking a deeper dive into the sale to third parties. And as a spoiler alert, our next webinar will actually be covering the sales or transfers to insiders, just to keep that in the back of your mind. So for today's discussion, here's just some highlights of what we're going to be covering. We'll do a quick recap of the importance of succession planning, which was covered during last series. Go over some critical elements of a successful transition. And finally, look at third-party buyers. What are the benefits, types of buyers, and some of the considerations for these transfers, different ways to structure, some different tax consequences to keep in mind based on the entity type. So first, let's do a quick recap of why you need a succession plan. And really what it comes down to is we see time after time during these transitions, during these sales of businesses, the ones with the best results are always the ones which took the time, had a plan in place. It could have been for years. It could have been, just a well-designed plan that they knew what they were doing, that they had goals in mind, and then really just executed to carry out these goals. And really, when you have these plans, a well-executed plan will increase the value of your business, and it protects you from these events, these unanticipated events occurring. You take a lot of the risk out of the transaction, and it definitely calls for smoother transactions for the most part. The other thing is, these processes take longer than most people think. So a lot of times, owners and of these family businesses, they're so involved in the day-to-day of the family business that they don't want to think of that time down the line, succession plan, who's going to take it over, what is going to be my exit strategy. There's a variety of reasons why they don't want to think about it, but you can't wait until you want to be out 6 months from now or even a year from now to give it some thought, because by then it is a long process. It can take long, and again, the more lead time you have to carry out and to plan for this, the better the outcomes generally will be. And finally, an exit out of the business, whether it be really internal transfer or external to a third party, this is generally the single largest financial transaction of your life. So, it certainly warrants giving it the time it deserves and thinking about it and planning for it as best as possible. So now just looking at some critical elements to a successful transfer, and this was just, again, a highlight from last series that was that Mike Kirkman covered. So as I mentioned, time is, one of the most important things when looking at these transactions. Pre-sale performance can enhance the overall value. What do we mean by that? Well, if you look at the business beforehand and do some planning and look at it from a purchaser standpoint and see what metrics they're going to look at to value your business, you can really put an emphasis and a focus on this and try and plan to maximize the value of this business to to maximize, again, the results. Next, qualified inside or outside owners. So again, if you're looking for an inside transfer, you're going to want to look at, okay, who are those insiders? Who are those, whether it be a family member or key employees or group of employees that have that skill set and the know-how of possibly taking over the business and transferring to those folks. Or if it's an outside, what type of outside companies might you sell to? And in a couple slides, Greg will go over some of those types of outsiders that are typical. Next, the tax efficient exit. So obviously, tax efficiency is a big item. This directly impacts the cash flow and the after-tax dollars received for a given transaction. And you're going to want to look at the owner's objectives. What is their objectives? What type of income do they want to achieve from this? It could be structured in a way where, they receive a lump sum sale. Sometimes it's a combination of a lump sum with an income stream, where they continue to receive an income for years after their exit. There's many different ways that can be structured depending on the business and the transaction, but you're going to want to give it some thought to achieve those goals based on what is desired. How the transfer of ownership occurs. So this is, again, the how, when, and why. It has a big impact. So will the transfer occur immediately? Will the owners exit the business immediately? Will they need to stay on for a certain number of years? These are all things that need to be thought about and planned in order to, again, to lead to a successful transfer. And then always, owners are going to want to minimize their risk. And this is, from a legal standpoint, you're going to want to look at many aspects, and it sort of leads into the next one, the importance of experienced advisors. In any sale or transaction, a team of advisors is very important. Aside from, obviously the CPAs, you're going to also need a team of legal advisors. It could be investment bankers in certain cases, wealth advisors, and really having that team in place, planned for in advance. Again, it's always leads to a better, smoother, more successful transfer of a business. 3 key principles to keep in mind for outside transfers. Again, you're going to want to remain in control of the process. And, I feel the best way to have control of the process is, again, and not to harp on the same things, but it's that time and having a plan, right? If you have enough time and you have a good plan in place and well thought out, you're going to feel control of the process rather than just kind of flying by the seat of your pants and taking things as they come. It's going to be a lot more difficult. Plans should always be designed to minimize risk. Try and look at different angles and different aspects of the transaction and reduce the risk to the seller. And finally, should meet financial goals. Obviously, the owners are going to have certain goals that they want met. It could be a value on the overall business. It could be an income stream. It could be a variety of financial goals, but you're going to want to know what those goals are, and then plan to achieve them and execute on that plan. And then, so benefits of outside transfers, and really this is sort of in comparison to, say, an inside transfer. So an outside transfer will benefit you. First of all, it will match your exit objective, right? I mean, this is just one that, if you are the owner of a family business and you don't have any insiders that you feel could carry on this business, you may not have family members in the business or any key employees that you feel have the skill set or the wherewithal or desire to take on this business, well, then guess what? Your exit strategy by default will likely be a outside transfer or to a third party, a sale. So that could just be, again, based on the facts and desires of what wants to be achieved. Second, minimizes the amount of contingent money. So with outside transfer, generally you're going to have more money up front, less of those contingent monies received as earnouts down the line, or even stretched out over a much longer period of time. Whereas sometimes with inside transfers, you see that can occur a bit more. Again, it kind of goes along the same lines, but increased amount of money received. There could be a larger amount received when selling to a third party potentially, and reduced amount of debt maintained or held by the sellers. And again, you're not the banker. Many times with inside sales, the sellers are retaining notes and receiving a series of payments over a longer period of time. Whereas with, again, these third-party transfers, these outsiders, that is less likely to occur, and many times it's going to be a lump sum payment, or a lump sum payment combined with a reasonable amount of payments in the near future. But that's much more likely with this type of transfer. And now Greg will begin discussing strategies for the transfers to third parties and go a bit more in depth.
Thanks, Mike. So we're seeing here that certainly there are a number of factors impacting the sale of one's business to these third parties and the ultimate success of that sale. The transaction can be structured in a number of ways, each of which has significant legal, tax, and business consequences for both the seller and the buyer. The deal structure itself can be just as important, if not even more important, than the sales price when looking to obtain the best after-tax result. That's why, as Mike has alluded to, it is extremely important to bring together a good team of advisors that help navigate the aspects of those sales. Here, of course, we'll be focusing mostly on the tax considerations, but having a team, with the legal counsel, with those business advisors that can work, hand in hand, can make for a much more smooth and beneficial transaction for you as the seller. So Mike started touching on the benefits of sales to third parties, and of course there are a number of factors at play here. Certainly the topic of the day and of the year, COVID, it has had an impact on both the buyer side and the seller side. Generally, we're still seeing that the industry is in acquisition mode, and you may even see prospective sellers who've been impacted by the pandemic and may be considering exiting from their businesses a little bit sooner than expected. At the end of the day, the old adage of striking while the iron is hot is still very relevant here. So once you've made that decision to pursue a sale, the next question might have to do with the identification of the buyer. So this discussion, of course, talks about sales to outsiders specifically, and you might be asking why an outsider. The answer might be as simple as there's no real viable related party purchaser that the seller might entrust to take hold of their business that they've grown over the years. The idea of business continuity, that's in the best interest not only of the buyer, but also of the seller, particularly if the seller retains some sort of financial interest in that continuity. This could be some sort of employment agreement, a retained minority interest, or an installment sale that's dependent on the cash flow of the business down the line. Overall, a related party transfer may simply not accomplish the goals of the seller, financial or otherwise. And this type of outsider or arm's length third party transaction may allow for better ability to manage financial risk and increase financial reward for the seller. At the end of the day, if there's no insider leadership, a strong consideration should be given to sales to third parties and making sure that you're going about it in a way that maximizes that financial reward. So we'll talk a little bit more about the types of third-party buyers here. We talked just now about identification of the buyer, that component of the process. And so in many instances, you're looking actually at your own competitors as those who may want to acquire your business and perhaps acquire a bigger market share. There are certainly private equity groups that look at your company as a promising one. And vertical integrators, they may be up or down the supply chain from you and looking themselves to move up or down the supply chain and incorporate your business into theirs. The strategies themselves, I mean, there are a number of strategies, but of course, there's a more traditional merger. You could roll up into a larger organization, and some of these strategies for the transfers do result in the retention of the equity of the new company. And what that does is it helps align the interests of the purchaser and seller, making sure that everybody's on the same page now and also moving forward. But the key, and of course the key piece here that we've been harping on a bit, is just balancing the risk and the reward. And here you're seeing much more of a finality to the transaction and the financial reward itself. So we'll get now more into a little bit of the nitty gritty in terms of the tax implications and aspects of the sale. Generally, there are various legal and or tax classifications for the entity that will be sold, each of which brings its own unique set of consequences in that sale situation. We've listed here a few of the more typical entity types: sole proprietorship, limited liability company. In many instances, those are taxed as partnerships, but can be alternatively classified. And then you have both S corporations and C corporations. So those are typically the entities that you'll see here. And then you also have the tax impact on the plans and on the purchase types of those types of entities. So there are a few permutations here as well. You have the outright sale, where all monies are collected up front. And then you have an installment sale, which kind of bleeds out the transaction over a number of periods and can have its benefits in its own right. You also have asset sales and stock sales. And so the combination of the entity types that we're talking about here and the purchase structures that we're talking about here can have a pretty significant impact on the ultimate tax implications for the seller. And so Mike and I will dive into those entity considerations and structure of the purchase a little bit down the road. We'll also want to look, we're talking mostly about the tax implications here, and that, of course, is a large aspect, a large consideration point for these transactions, but there are a number of other more practical business applications here. So we have listed here a number of significant factors, the first of which, as I mentioned, is the seller's tax consequences, just the amount of tax ultimately paid by the seller in connection with the transaction. You'll also want to look from a purchaser standpoint, the ability to step up the basis of those business assets it can be a pretty significant, can have a pretty significant impact here. The ability to step up can generate a tax benefit when those assets are depreciated or amortized, and ultimately when they are sold. There's the potential assumption of the business's liabilities, including those that may not yet be recorded at the time of sale. Another consideration is the continued existence of the business entity itself. That can be particularly key when you're looking to continue with any related tax benefits for the entity, such as net operating loss carryovers. There's the continued ownership of the business itself. We had talked a little bit about retaining a minority share and aligning interests. And so there may be some owners that do want to continue in the business in one form or another and may not want to sell their entire stake. There's, from a practical standpoint, the purchaser's preference to avoid significant asset retitling, such as, say, a large fleet of vehicles, as well as the purchaser's ability to utilize existing contracts in place, such as favorable leases, maybe supply agreements, or other contractual arrangements that, again, the purchaser may want to retain.
Great, thanks, Greg. So now we're going to look at go again a bit more in detail and look at the various types of entities and what the general preference between a stock sale and an asset sale is, as well as the tax consequences for these types of sales transfers. So first, we'll start with a C corporation. So the seller of a C corp, there's typically a strong preference for a stock sale rather than an asset sale. Now, why is this? Typically, generally it's tax driven. And the first thing is that it avoids built-in gains that would be taxed to the seller. If they were to sell the assets, the corporation is going to pay tax, and then they're going to get double taxed when the corporation has to distribute the net assets to the owners. So when you do a stock sale, that is avoided because you're selling the stock, and the built-in gains will eventually be taxed to the purchaser when these assets are sold sometime in the future. Second, the gain is generally capital in nature. When you're doing a stock sale, you're getting that capital gain, which has lower and more beneficial tax rates, assuming that stock has been held for 1 year or longer. Some other reasons: the gain may be eligible for a qualified small business stock treatment, resulting in a full or partial gain exclusion. So this is one where, again, there's several different requirements in order to meet the qualified small business stock classification. But if an owner does meet those requirements, it can be very beneficial, but it would require stock sales, which is why, again, another reason for the preference. And finally, the liabilities will remain with the company with a stock sale. You're selling the actual shares of stock to a purchaser. That company, the business, is staying intact, and any liabilities will stay with it. So now, let's explore the tax consequences of corporations. And to be clear, this is with a C and an S Corp. So first, we'll look at the stock sale. Tax consequences. First, you have the capital gain or loss will be equal to the sale proceeds less the basis of the stock. So it will be capital. If the stock was held for 12 months or longer, it's going to be subject to long-term capital gain rates, which will be 15 or 20%. Generally, imagine we're in the 20% tax bracket here. And installment sale is another wrinkle that many times comes into play. So if the seller finances a portion of the sale, doesn't receive all of the funds up front, and some of the payments will go into future years, or over a period of, let's say, 3 or 5 years, whatever it might be, you can elect installment sale treatment, and essentially some of that gain will be deferred and recognized in future years as those funds are received. Then a final note is that if the funds to purchase the stock come from the business itself, the transaction could be recast as a redemption, which could be negative or have a negative tax impact to the seller. So this is just to mention as a caution, to make sure that it's structured properly and to avoid any surprises from a tax consequence from a tax standpoint. Another, as it relates to stock sales, one thing I did want to mention was a certain election, which is quite popular, that if an S Corp is being purchased by a C Corp, there is a tax election that can be made. It's Section 338 election, and what this does is it treats the stock purchase as an asset purchase for U.S. Federal income tax purposes, and most states follow as well. So what this does is for income tax purposes, since it's treated as an asset purchase, this is beneficial for the purchasers, for the buyers, because it allows them to get a step up in basis to the assets that they're purchasing, and thereby, have larger depreciation and other expenses. So this is beneficial. So you kind of get the best of both worlds. So it is quite common that these transactions to be structured in a way which then this election can be made. So again, it's getting a bit in depth, but I did want to mention because it's quite common. Next, looking at the asset sale, tax consequences of an asset sale, again, for corporations. So when a corporation is selling their assets, the big thing that needs to be done is a purchase price allocation. And here, the selling entity is simply allocating a portion of the sales price to each asset sold. So from a practical standpoint, say a corporation is selling its business or selling the company for $10 million, they will need to do this purchase price allocation. And how it works is you're looking at your balance sheet, you're looking at all your assets listed out, and you are going to assign them each based on their fair market value. You're going to do an allocation of that $10 million to each type of asset and asset class. So could be, cash, inventory, accounts receivable, fixed assets, and just all the assets of the company, and anything in excess of the fair market value of the assets generally gets classified as the goodwill. And then essentially you calculate the gains or losses on each of these classes of assets. Depending on the character of the asset that's sold, you could have capital gain treatment on some, ordinary treatment on others. So it'll really depend on this purchase price allocation. And this, as you can imagine, is a strongly negotiated aspect of a sale. You have the sellers, which typically want to allocate to classes of assets that are going to give them capital treatment, and you have the buyers that typically have conflicting, wants on where to allocate. So this is certainly negotiated, and there is a tax form that will get filled out, 8594, that actually gets reported to the IRS with this purchase price allocation that's agreed upon by the seller and the buyer. And then final note, after winding up any business after an asset sale, they pay tax on these asset sales, and typically after that, the business is liquidated. And for a C corporation, this will result in a double tax because any funds remaining during this liquidation process will be taxed generally to the owners of this corporation. You don't have the same double tax issue with an S Corp, but did want to reiterate that for a C Corp. And now Greg will be going over some of the impacts when looking at the flow-through entities.
Thanks, Mike. So yeah, Mike first started off by talking about C corporations and then some of the commonalities with S corporations. S corporations are one of the two main flow-through entity types, with the other being partnerships. And so what I'll be talking about is some of the common points between those two types, S corporations and partnerships, both within the umbrella of flow-through entities. And so here the detrimental tax effects of selling assets are not as extreme, predominantly because there's a single layer of tax when you're looking here, as opposed to with C corporations, which do have that double layer. One item to note, though, is that while there is one layer of tax with these flow-through entities, some or all of the gain here may be taxed at ordinary rates. You'll also want to note that asset sales by S corporations that were formerly C corporations may trigger a built-in gain tax. And one thing that Mike had mentioned that I'd like to drive home a little bit is that we're looking at this mostly from the perspective of the seller, and in many instances the seller and buyer preferences are opposed. But hopefully and ultimately the idea is that the desire to close a deal is enough so that each party comes together, makes certain compromises to get the sale over the hump. One key note here, we talked about flow-through entities. I'd like to talk a little bit specifically about partnerships here. And so the tax differences when selling assets and selling an interest in the partnership itself is relatively minimal. The gain on the sale of a partnership interest would be ordinary income still, to the extent that the partnership owned assets that would themselves generate ordinary income if sold. These are called hot assets and typically include things like inventory and accounts receivable, as well as certain assets that are subject to depreciation recapture. So we've hit on kind of the basics of the different types of transactions, the different entity types. And I also wanted to touch on a few other considerations here. Not that this list is exhaustive, but we've seen these types of issues come up more frequently than others, and wanted to mention them here. One is state tax implications, things such as goodwill apportionment, or even things as straightforward as the residency of the seller. They're just important to take into account ahead of time, and if possible, just evaluate for any potential for gain minimization. You'll also want to look at the net investment income tax. So that's a 3.8% tax, potentially stacked on top of the either capital gain rate or ordinary income rate that you are already paying. And so that net investment income tax can be minimized and managed based on factors such as the nature of the business's assets and even the seller's activity in that business. So keeping that in mind, and again, taking the time ahead of the sale to try to manage those types of things is vital here. And one other consideration that we'd like to specifically mention is just related to installment sales that we've been talking about, the seller financing option. And so this works best with stock sales and can be mutually beneficial in that not as much upfront cash would be needed by the buyer. And on the sell side, you do have that gain deferral option. But with that gain deferral comes a little bit of risk for the seller in that you're not collecting everything up front. And from an income tax perspective, very specifically, any aspect of the sale that would cause ordinary income recognition would have to be recognized all up front, even if the collection period spanned a number of years. But all of this is to really say that your team of advisors is important. All of these combinations of entity type and purchase type and these considerations from an income tax perspective are important to take note. And if you have a team of advisors that have been around the block and understand these implications, it can make for a much smoother and beneficial transaction. And Mike's going to talk a little bit about just kind of overall what we've seen from a succession planning standpoint, particularly with these transfers to third parties.
Thanks, Greg. It's really just to kind of summarize, what we've covered. Again, this is a very complicated area, and these transactions and the way they're structured can get incredibly complex, which was really kind of outside the scope of this conversation. Of this presentation, but hopefully, this did give you an overview and a lot of the general basics of this topic and the various structures and based on the type of entity. Some things you're going to want to focus on and takeaways would be, again, determine the goals and objectives. I think that's just giving it thought. Every business is unique. Every owner and their situation and their goals are unique. So really, it's just coming up with this game plan and developing it, hopefully early enough where you have that time and that lead time prior to the desired transaction or transfer. So, and then finally, you have the actual implementation and execution of this game plan. And over time, as it will likely change, and you'll have to be fluid, and certain things may change, which will change your plan. But if you have a plan in place, generally you will get the best results, and we see that time and time again. the last thing, we've mentioned it a couple times, but you're engaging advisors for guidance, and that's, legal, accounting, investment, management. It's all very important. And I thought it'd be helpful to highlight some of the types of services that Cherry Becker can assist with, for example, and add quite a bit of value to the business and the transactions. So some examples, sales side, quality of earnings, and possibly audited financial statements. So too many times we see a business that maybe didn't plan for succession or to sell, and all of a sudden in a short time frame, they certain buyer is interested in purchasing the business, and first thing they do, they want to look at the financial statements, and time after time, that's you can hit some snags and encounter some issues that can be deal killers. And if in advance of this and planning for an eventual sale to an outsider, to a third party, we have experts at Cherry Becker that will do some quality of earnings analysis. They'll look at your financial statements, make sure they're in order, make sure they're in the proper formatting, proper conventions. Basically look at it exactly how a purchaser would be looking at it. And then if there's any issues, issue a sort of report on what can be improved upon. In particular, what types of financial metrics are going to be used to determine the value of this business. And again, that with that knowledge is power, and you can certainly increase the value of the business by targeting certain metrics and increasing those, and or at least the goal to increase certain metrics, which will increase the overall value and sale price of a business. Due diligence, again, our mergers and acquisition folks can assist with due diligence for an actual transaction and deal. As we discussed before, there's purchase price allocation in the case of where it's necessary with an asset sale. We certainly assist, our valuation folks will assist in that allocation that is certainly necessary and is done with these transactions. We can assist with that. Valuations, many times valuations are required of different assets within the businesses or various assets. We have an excellent valuation team that assists in these transactions quite frequently. Compensation planning, state and local tax. So if any business is doing sales and operations in various states, you're certainly going to want to take a look from a state and local tax standpoint, make sure you're in compliance, make sure things are being done as efficient as possible. And again, not to, if say a company is not in compliance with state and local taxes, that can create issues for the transaction and can be, again, a deal killer or cause issues for a potential purchaser. And finally, our wealth management team can certainly add tremendous value by looking at, okay, if you sell the company for X amount of dollars, is that going to be enough based on my goals, based on my financial goals and plans for retirement or whatever it might be that the owners have in mind post sale. And they can certainly assist with this analysis and add a tremendous amount of value to just determine if there's a certain goal in mind. So with that said, thank you very much for your time. And if there's any questions, please feel free to reach out to either Greg or myself. We have our contact information on the screen. Thank you.